right, welcome everyone to another HSI info session with Stacy Spencer, real estate investor, developer. How you doing today, man?
Great, man. How about yourself? How you doing?
I'm making it.
Work hard or not?
Another hard day,
Another
another
hard
hard day.
day.
But you know, I found out I have to slow down sometimes. We had that discussion the other morning, so I got to slow down.
Got to, man. Got to take care of yourself first. Can't pour from an empty glass, right?
Right. Let me turn this up a little. All right. So the reason we're here, we want to talk about how to find a good property when you're doing any real estate investing, right? So the first question I have, I'm gonna jump right into it. What's the first thing you look for when you're deciding if a property is worth your time?
The first thing is location. Location, location, location. Then once you lock in on location, it's all about the numbers. Um, and you gotta, if you have a niche, then you'll look at specific things, but like the zoning. If you're an Airbnb investor, you're gonna look at zoning. You want to make sure that you can do that. But typically, I'm looking at location and I'm looking at future growth. I'm looking at the property itself, the condition, just everything about it, and that'll factor into how much you should be willing to pay for it. The condition itself is not a deal breaker. However, it's all about the numbers. But the first thing I'm looking at is location.
So location. So
hmm
what elaborate more on location? Like give an example.
Well, a good example is any location that you choose should allow for the big three I always talk about: appreciation, cash flow, and equity. A lot of that is location driven. Specifically appreciation being location driven. You gotta think like that's one of the pillars for investing or good property. So you just got to make sure that that area is moving in the right direction. So first is location, hands down. Is that area going to move in the direction I need for it to appreciate and for it to basically make money without me even having to, do too much or do anything over the years.
So generally speaking, what's a bad location where you want to stay away from?
Again, that's dependent on the particular niche or type of investor. Some would say the D class neighborhoods stay away from. However, some will say that's not necessarily true. You get great deals. You have a little bit of flexibility on options as far as uh, group homes, buy the rooms, etc. But it depends. If you're an Airbnb investor, a bad location is going to be one where zoning will not allow for that. As a single family home renter, a bad location would be one where it does not meet all three of those uh those pillars. Um for me personally, on the business side, I like to I like to have an established team as well. So that goes into location as well. Yeah, if that makes sense.
Okay, okay. So what is a D class neighborhood? Like what's the criteria?
So you have, yeah, when we say D class neighborhoods, you're talking about neighborhoods that a lot of crime, high poverty. The property values aren't necessarily moving as rapidly as the other parts of the city, the town. That's pretty much what I mean by D class.
So when you're investing, you got to take emotion out and look at data, right? Not
There you
just go in and say, I want to help this community if you're looking for income, correct?
You can be a community minded investor, and I like to think that I am. But again, that goes back to it depends on what kind of investor you are. If you're driven by numbers, and which we all should be, doesn't make sense if you're not. But if you're you're community minded as well, you can go into some of those neighborhoods and you might not make a huge impact, but you can have an impact. So again, it depends. Um, but for me personally, it's got to still meet all three of those: appreciation, cash flow, and equity walking into it.
Okay,
Um,
okay, got you.
And that's driven by location.
So speaking on that, I want to really expand on that. So, how do you balance location versus price versus condition when evaluating a deal that you are going to go into?
Comps. Comps in that area is what's going to drive that bottom line number. Comps along with just the strategy that's going to be executed for that property. But
So,
comps is what drives those numbers.
just for people that don't know, and maybe they're new to all of this, what are comps?
Comps are properties in a particular area, neighborhood, radius, that have sold within usually 3, 4 months or in the past. And that's what sets the market is how much is someone willing to pay for a house? How much is someone willing to sell it for? That's what sets the market. So your comps are transactions, houses that have been sold, properties that have been sold in that area.
And you say in the last 3 or 4 months.
Well, yeah, it's no more than six to 9 months, but three to four is a safe because the market can shift fast. So you want some relevant data. You don't want to look at something from a year ago.
Yeah,
No
gotcha.
one's, that's old. That's old data.
Okay, okay. So I do want to go back to appreciation. So can you explain what appreciation really means in a practical term for new investors?
So appreciation is in the most basic way to explain it is appreciation is the value in something increasing with time. That's appreciation.
And it keeps going up, right? It doesn't go up for a period, but it's projected to go up um in like continuously over years, not just like it's a spike and then it goes down.
Yeah, no, not a spike is that's not considered appreciation, but continuous. There will be some years when the market corrects, and you will see those values go either stabilize or go down. So there's years when, just like the stock market, the real estate market, those numbers go down. So, but we're talking over the course of 10 years. There's
Okay.
never been a downward spike for continuous years.
So you got to
So
think long term, right? Don't
long
think
term, man.
short term when you're trying to hold a property.
No, no, and you you can be short term, but that's more on the flip side. If you're a flipper, then short term, yeah, if the market's hot, you can go with that. But it's the long term. Appreciation is over the long term.
Okay, okay. And
Or there's forced appreciation. If you buy a property and renovate it, that's forced appreciation, and that can happen rather quickly. But the key is appreciation one way or another.
I was watching I don't know, it was a clip. I don't know if it was on Instagram or Facebook or maybe it was YouTube. They were talking about how fast you can put money back into a house and it is worth more. So when you say forced appreciation, it's something that's spawned in my mind. So I heard, which I don't know because I'm not a real estate investor yet, but I hope to soon. I hope soon to be. But they say the kitchen and the bathrooms are where you should start when you are renovating your house to force the price up. Is that
Hmm.
true?
Yeah, I mean that's pretty standard across the industry. Kitchen, bathrooms. That's where you can get a good return on your investment with if forced appreciation is your strategy. So, but yeah, that's generally true.
So why is that? You start with the kitchen and the bathroom. This may be a stupid question to you, but I want everyone to know like why you want to start there.
I mean, as again, the market is driven by what people want, what buyers are willing to pay. So if that's where most buyers place their a requirement or what they really want or what they look for, then that's where you put your money to get them to buy. It makes sense.
Yeah, got you.
Give the people what they want. So it's market driven.
Okay, market driven.
Market
Kitchen,
driven.
kitchen, bathroom. Okay, I guess
Hmm.
because you spend most of your well, you're always gonna go in the kitchen. You're always gonna go in the bathroom. I
That's
like
right.
to for things to make sense.
That's
Make
right.
sense, right? So, indicators, right? So you're going into like you're trying to find a property. What are some good indicators that you use to say this is a good property? I know we talked about comps, we talked about um, different areas. So what do you look for like as an indicator that appreciation may be going up soon?
A great indicator is movement, like other renovations going on in the neighborhood. That's a great indicator. Construction, new infrastructure, new sidewalks, new construction homes, new playgrounds, just rejuvenation, so that's a great indicator. And then being able to dig into resources like that your city or your township may offer as far as 10-year comprehensive plans. That's another great resource to kind of figure out if you're investing in a good location. So digging into what the government has going on in their plans for an area, that's another way. So
How do you
there's a
find
lot.
those plans?
you know.
How do you
What's that?
find those? I say, how do you find those plans? That
Google, brother. Google is your best friend. Google is your best friend. Whatever your township is, your city, um, chat too. Chat nowadays is better than Google. Ask
yeah.
chat. Does my city, whatever your city is, Raleigh, Durham, North Carolina, what is our 10-year comprehensive plan? It'll probably point you right to a website. And you could go in there and kind of see the areas of the city that they're going to focus on over the next 10, 20, 30 years. That's a good way to get ahead of.
Hmm. Okay. So always look ahead and then scale it back to where you
Right,
are.
right,
Okay.
right, right.
Gotcha. Gotcha. So I know we talked about potential and buying properties and what you look for, but what do you look at when you're trying to stay away from a property? Like something just a red flag, like you go into a neighborhood maybe, or you go into an investment, like you think it's good because you found it online, you want to go check it out, or you riding by. What are some red flags that make you walk away from a deal?
The seller won't negotiate. The seller wants more than it's worth. That's the only red flag to me.
So are there any physical red flags like once you go into a house and you're like, oh, I can't do anything with this? Like, are there anything? Is there anything physical or things that you look at that make you say, no, I'm not going to do this?
Again, that is more investor driven. You have to know where you're at and what your capabilities are. Some investors may not be capable or don't want to do anything beyond lipstick flips, basically where they just go in and do basic cosmetics. Me, on the other hand, I don't mind. There's no red flags to me because it all could be fixed. So if the price is right, it's a good deal to me if the price is right.
Okay, so the price is right. So let's go into overpaying. So how can a new investor avoid overpaying for a property in a hot market?
Um, how can an investor just not doing their homework and not knowing the numbers, not knowing the comps in the area, and not asking for help? Reach out to people who actually know what they're doing. That's really the best indicators. And then another thing is to understand that markets can be very tight. So if you're looking in a zip code, um, you might go 2 blocks one way and you have a $500,000 house, and you go 2 blocks the other way and you got a 250,000 houses. You know what I'm saying?
Mm-hmm.
So it's
Got
just not really doing your homework and knowing the market and knowing the numbers and not being emotionally driven. And again, get you a mentor, somebody you can ask these questions to.
And that's why we are here in the community. So when they have questions, maybe they could ask you. So
Anytime.
so okay, so
Get dark on me, man. Can you see
yeah,
me?
yeah, it's getting dark out there. We're gonna wrap it up a little early because I know it's getting dark pretty quick. I know
It's all good,
time
man.
is. So when it comes to repairs and renovation, how do you calculate what's too much for a property?
A lot of people use a formula. They'll take the ARV, which is the after rehab value, or the whatever they anticipate it'll be worth by the time they execute their strategy, whether that's a rental or a flip. The ARV. They'll take and they'll have a percentage that they want to make, subtract that from the formula. Then they'll take and factor in the repairs, subtract that from the ARV. And did I miss something? Yeah. So you subtract out, it's a formula for it, man. You run those numbers, and again, you just you go through your numbers, and if it makes sense for your strategy, you execute.
Okay, so what
If
we'll do
possible,
is
if.
we'll find that formula and we'll put it in the school community for anybody that wants to know that formula. Just another perk for being in the school community.
Right.
Now we're gonna wrap it up early because it's getting dark out there. But the last question I do have: if someone's watching wants to start investing, what's one actionable step they can take this month? Well, we're kind of at the end of the month, but let's say next month, that they can start investing.
Um, Research. Just start digging through resources, reaching out to people. That's really a great step. And sitting down and putting a plan on paper, putting a budget on paper to actually execute. Before you even reach out to someone, like come up with a realistic numbers based on what you have going on, and then reach out to somebody and have those conversations.
Okay, so if you want to start investing, join the school community. That's what we can do. You want to start like because you have all those resources there. You have Stacy there, and what I do is I put systems in place as well. So the execution will be there for you, not just you putting a plan together and then that plan going under in the next 2 weeks because you haven't worked on it.
Right.
So that's one benefit that we do have. So yeah, it's getting pretty dark out there now.
You got dark fast on me, man. You caught me on the grind. I got caught up at
It's
work,
cool.
man.
It's cool. So we'll the next time that we go live, we'll just have a part two, and we could cover some of those things that we didn't today. But we'll wrap it up pretty quick tonight, and then, like I said, the next live will be in 2 weeks. So we'll just continue in 2 weeks.
Absolutely, man. Plenty more to talk about.
Oh yeah. So that's all for tonight, guys. Pretty quick session, but like I said, tune in to the week, not next week, but the week after, and then we'll continue this conversation if you want to learn about real estate investing and being profitable, not just jumping in and going into super debt because
Right.
you don't want to do that. All right, until the next time, guys. Later.
Peace, man. I'll talk to you.